This conference will now be recorded.
Hi, and welcome. This is Jason Labrum. I'm the founder and president of Intelligence Driven Advisors. We wanted to get back in front of you with another presentation on markets and volatility. Yesterday was wild. We had the single biggest point drop in the market's history, over 2,000 points. Today we had one of the biggest point gains, over 1,000 points. So it's a wild, volatile time to be an investor right now. And we believe that putting data and information in front of you will help you make better investment decisions. And that's what we're all about here at Intelligence Driven Advisors. So thank you for watching. I'm going to go through a few slides here and talk about them a little bit, annotate some of the things. It should be brief, but hopefully potent and help you maybe ignore some of the sensationalism that the media is putting out there and help you make better investment decisions. So thanks for staying tuned and watching. Here we go. So one of the things that we wanted to address given this coronavirus situation is how has the market responded to previous market crisis? And if we look here at a 60-40 portfolio going back, we can see that the stock market crash of '87. We can see the U.S. savings and loan crisis in '89. We've got the Asian contagion Russian crisis of 1998, dot-com crash, of course, the terrorist attacks and the bankruptcy of Lehman Brothers and the 2008 credit crisis. And then we look at how the market had behaved 1 year later, 3 years later, and 5 years later. And drawing attention to the 1 year, you see that 1 year later, in a lot of cases, it was up. Actually, out of the 1, 2, 3, 4, 5, 6, 7 cases, it was up in 5 of those cases. Sometimes not very much. Some cases more significant. But when you look at the 3 and 5 year, you see some significant recoveries of the markets and how they respond to different events and different crises. So I think the message here is staying put, staying invested, sticking to your discipline is what will work. As we see, there has never been a downturn where the market didn't recover. And so we believe that capitalism prevails and exists in the world. Companies will create products and services. It will sell those for a profit. And if you have the right diversified investment philosophy, you will do very well. So one of the other things we want to take a look at here is going clear back to 1926, and we look at the history of market ups and market downs. And we're looking at a 10% threshold here. So you can see that there are several times where the market was down 10%, all the little red spots, but notice how much shorter or smaller they are than the blue where we were in a bull market. And you see also not only the duration is shorter, but the severity is often shorter. So we're not here to tell you there isn't going to be another recession or bear market. We're here to tell you it'll probably be shorter than the last bull market and the next bull market. And we also are here to say we just don't know when it's going to come or how severe it's going to be. Nobody could have predicted a virus that was going to spread globally and cause panic and all the toilet paper at Costco is going to be gone. Nobody predicted that, but yet it happened. So it was information the market didn't have. It's repriced, and we're pricing in basically the economic impacts of that. But this too shall pass, and maybe it turns into a red spot on this chart as we look forward, and maybe it doesn't even turn into a red spot, and this is just a very temporary downturn. Don't know, and it doesn't really matter because we can't guess and predict what's going to happen. Instead, we can build a great portfolio that will help us do well regardless, do well in any weather, and over time, if we stay put, it will work. So let's take a look at a couple other different perspectives. One of the things that we heard a lot about prior to the coronavirus was the markets are at all-time highs. It must be time to get out. Or I think I'm going to get on the sidelines and wait. The problem with that is that you leave yourself in a high percentage of time missing out on further increases. In fact, if you look at every time since 1926 the market hit a new high, that 1 year later, the average return was another 13.9% from that high. 3 years later, the average return was 10.5. And 5 years later, the average return from that high was 9.9. So just because the market hits a new high doesn't mean it's going to not continue going, doesn't mean it's going to go down. And it certainly doesn't mean it's time to get out. So if we look at the average annual returns after a market decline of 10% or more, so the market went down 10% or more, we can say what happened a year later. Well, the average return was 11.3, and the average return over 3 years was 10.2, and the average return over 5 years was 9.6. So whether the market's at a new high or at a new low, it's very difficult to try and time it and get in and out. But if you do stay in, you can see that the statistical odds of having a good return over time are very high, which is fun. Here's what's not fun is that we go through these emotions as investors, right? You feel them, we feel them. What we do is bring a discipline and philosophy and process to investing so that we don't get overtaken by the emotions, the headlines, or events and start to make bad decisions. Typically, people are very excited and want to talk about buying stocks in here. Here, they want to sell them and they're very fearful. And that just obviously doesn't work because you end up buying high and selling low. As opposed to rebalancing, if we rebalance a portfolio on a regular basis or whenever the pieces of the portfolio grow to a larger than desired percentage, we can trim the profits out in that. And then we're doing just the opposite of what emotions do. We're trimming up here and we're buying down in here. And that works very well. And that's one of the strategies we deploy at IDA on a daily basis. Doesn't mean we trade every day, but we are looking at your accounts every day to see if there's an opportunity, or our clients' accounts every day, for those of you who aren't clients, but we're looking there to see if there's an opportunity or if any of our tolerance bands have been breached, the lower or the higher, and we trim profits. It's very disciplined, and it allows us to typically sell at the top and typically buy near or towards the bottom. If you live in Southern California, this is relatable because picking the fast lane is stressful and it's very difficult to figure out which lane is going to go faster. Sometimes it's the slow lane, sometimes it is the fast lane. But it's a very stressful situation if you drive like that, and if you drive in Southern California, I'm sure you've experienced it. I know I have. But it's the same as investing. If we're trying to get in and out of the market, if we're trying to pick when to do the right things or rotate sectors, it's not only unproductive, but it's also very stressful. So we want to help clients achieve true financial peace of mind. And we do that by building an investment strategy that's directly tied to your financial plan, knowing what your goals and objectives are and what you want to accomplish. We take the least amount of risk possible in doing that, the least amount of volatility in achieving your goals and objectives, and then we get to have a very nice, peaceful journey, and we also become much more successful investors because of that process. I love this because when we go for a while like we have, where the markets don't have big downturns, we start to think that volatility isn't normal and part of investing, but it is. Volatility is part of investing. It's normal. It happens every year. In fact, almost every year. If you look at this, you'll see in the red, the largest intra-year declines. And you can see that almost every single year there is significant intra-year declines. And you can see almost every year there's significant intra-year gains. And then the average annual return, the calendar return for the years in the shaded blue, most of the years it's up, roughly 75% of the years the market's up, and up significantly even in years where there was down. Some of these you see big significant downs, but yet the year ended up positive. So volatility is normal and natural. It's kind of why we get rewarded as investors, because we have to endure. We have to endure some up and downs, and not everybody can do that. And thus there is a nice reward for those who do. The bottom line is we know that investing has rewarded investors. If you take a look here, you can see that a $1 invested back in 1926, a long time ago, but $1 turns into $20,000 in small cap stocks. $1 turns into over $7,000 in large cap stocks. And look at the big gap. $1 turns into $142 in long-term bonds. Not saying you shouldn't own bonds, but by being a disciplined investor and staying invested and staying true to a discipline and philosophy, you get a really nice reward for doing that. And that's what we're trying to help you do here at Intelligence Driven Advisors, is stay put so you can get the reward. Also, as a quick sub highlight, if you notice the difference between US small cap and large cap, almost double. Most of the prospective clients we see that come to our firm have a large percentage of their money in large cap because they're names they know and they've heard of and they're household names. However, they give up a lot of upside potential by not having more diversification into the mid and small cap. So clients at Intelligence Driven Advisors do have more diversification, into the mid and small cap stocks, which help the returns over time. Looking at the distributions of returns, here we go clear back to 1926 again, and we're looking at the blue is all the positive returns and the red is all the negative returns. And you can see there are certainly more blue than red, and you can see this coagulation of returns right here in this, 10 to 20, 10 to 30%. And then the bell curve, there's some outliers that were scary and pretty nasty. You see 2008 was, one of the worst. And then you can see 1933, 1958, and some other years there were phenomenal. But the general returns fall in here. This is just in stocks too. So if you have fixed income, your returns are more subdued, or if you add bonds into the portfolio, you can have a more gentle ride, so to speak. 74% of the time, the markets are positive, 26% they're not. So we should, when we build portfolios and we invest, we should expect that there are years we're going to be down. That is part of the process, and we have to go on that journey and hopefully do it in a way that's peaceful. And your financial plan is on track because you revisit that, you make sure it's safe, and that you are going to achieve your goals and objectives, but and expect for certain years the market to be down. One of the reasons why we're advocates of allocation and diversification is because it reduces volatility. And when you reduce volatility, you don't have to recover. This is a great example of the portfolio one that is up 50% one year, and then year two it's down 50. So your average return was 0, but if you look at your compounded return, it's negative 13. You only have 75,000 because if you go down 50 with a $100,000 portfolio and you go up 50, you're only up half the way. You need to actually go up 100% to get back to even. Portfolio 2, you have 10% up and 10% down. Subsequently, you have a 0% average return as well, but yet your compounded average return is much higher because you didn't go down as far. So this is why it's also very important to have diversification. It's why we don't just buy the S&P 500, and especially when it's done very well as of pre-coronavirus. But we don't just buy one sector or one asset class. We get diversified so that we reduce the volatility in our portfolio, and that helps us have longer-term better returns. There has always been reasons why we should not invest. There's always been reasons to panic, headlines and events. Here you can see several of them that you may remember and have invested through, but yet during the same time, $1 turns into $69 in the MSCI World Index. So this is a great representation of all stocks out there, and you can see that if you stay disciplined through these scares and these events, you actually do quite well. Kind of the same story, right? It starts to repeat itself over and over again. So in summary, we want to help you, and what we're worried about and what we're thinking about every day is what can we control? What are the things that we can do? We can help you build an investment plan and strategy. We can tailor it to your personal financial plan with all your passions and your life dreams and what you want to accomplish. What is your financial purpose? We can structure a portfolio so that it delivers the best returns for the amount of risk or volatility we're willing to accept. And we can get diversified globally because we know that that works out better long term. That means we own U.S. stocks, but we also own some international stocks as well and emerging market stocks. Managing expenses is a big deal. We focus on keeping expenses very low. Turnover and taxes can really add up over time. So our philosophy and strategy is one that optimizes, reduces turnover and reduces the taxes as much as we possibly can. And then the biggest thing of all is to stay disciplined through market dips and swings. It's not easy, but you get rewarded if you do it. We are here to help you. We want you to talk to us. You're not an interruption to our work. You're the reason for it. And we thank you so much for the opportunity to present this to you. And no presentation is complete, of course, without a healthy dose of disclosures. So we'll show those disclosures real quick. And please know that you can reach out to us at any time. And our number is 760-707-5555. That's 760-707-5555. Thank you so much. Happy investing. Stay calm and carry on. This too shall pass. I'm Jason Labrum with Intelligence Driven Advisors. Thanks and have a great night. Bye-bye.